November 2025, Bitcoin briefly touched around $109,000 before entering violent volatility, and Ethereum once surpassed $4,900. But if you're still hoping this cycle will deliver 10x, 100x gains, you're very likely repeating the same mistake millions made in 2018 and 2022, going all in near the absolute top, only to watch your wealth evaporate. This isn't doomerism. This is a historical pattern that has already repeated 3 times, and the 4th is happening right now. 1. Looking at each bull market cycle, the biggest wealth gains have already been taken. First cycle, August 27, 2015 to January 9, 2018. In the early stage of the market, total crypto market capitalization skyrocketed by an astounding 234 times, within about 1,000 days. Bitcoin rose from $200 to $19,800, nearly 100 times. The ICO boom created overnight millionaires, and ETH surged from $1 to $1,400. This reflected a market with an extremely small base, high speculation, and an explosive early adoption phase. Second cycle, February 9, 2019 to November 12, 2021. With institutional funds and mainstream attention pouring in, the market experienced another bull run. Bitcoin climbed from $3,400 to $69,000, a 20 times increase. DeFi, NFTs, and countless 100 times altcoins emerged, and ordinary retail investors could still get rich from extremely speculative tokens. But despite also lasting around 1,000 days, the total market cap grew only 25 times, showing that as the market expanded, its ability to deliver explosive returns began to decline. Third cycle, January 3, 2023 to October 8, 2025. In the newest 1,000-day cycle, growth expectations have slowed even further. Total market cap is projected to rise by only about 4.5 times. Bitcoin climbed from $16,000 to a peak of $109,000, only 7 times. And more than 80% of the profits were captured by institutions, ETFs, market makers, and insiders. Looking at the previous 3 bull market cycles, the dramatic drop in 1,000-day growth multiples, 234 times, 25 times, 4.5 times, together with the market cap once reaching $4 trillion, clearly points to one conclusion. Retail investors get a smaller and smaller share of the upside every cycle, and marginal returns are collapsing. This is exactly what happens when an asset becomes mature, volatility decreases, pricing power shifts to institutions, and the get-rich-quick era comes to an end. Implications for the market. Volatility will shrink as market size grows, and the participant mix becomes more complex, including many conservative institutions. Hedging and arbitrage funds will reduce market volatility. The market absorbs shocks more efficiently, reducing both the frequency and magnitude of extreme moves. Efficiency will improve. Capital inflows and outflows can no longer move prices by hundreds of times, because it now takes hundreds of billions of dollars to generate meaningful price shifts. From the launch of the Bitcoin network on January 3, 2009, to 2025, the cryptocurrency industry has gone through 16 years of development. And in most markets, after roughly 16 years of explosive growth, there is a high probability of entering a mature phase. For example, Nokia experienced a period of growth and prosperity from 1992 to 2007, lasting 15 years before its decline. In short, the continued slowdown in growth multiples, together with the market's massive total valuation, shows that the crypto space has already moved past its phase of explosive expansion. 2. A real ceiling has already formed. The era of institutional pricing is here. After U.S. spot Bitcoin ETFs were approved in 2024, global capital now flows in through regulated channels. Price is no longer driven by retail emotion, but by the buy-sell orders of BlackRock, Fidelity, MicroStrategy, and other giants. Retail is just eating their dust. Regulatory iron curtains are descending. The US, EU, China, India, Korea, every major economy is tightening the screws. In the future, exchanges need licenses, wallets need KYC, stablecoins need audited reserves. The gray zone profit era is dead. Technological dividends are exhausted. Bitcoin halving rewards are getting tiny. Next halving drops block rewards to just 1.5625 BTC. Layer 2 scaling is mature. No more. Gas fees 100x overnight. Miracles. Most AI plus blockchain narratives turned out to be hype with almost zero real adoption. Looking at the performance of others.d, it's clear that in this bull market, the total market cap of altcoins consistently lagged behind the broader market. Later on, there were no explosive surges or the extreme volatility we've seen in previous cycles. The wealth effects that retail investors were hoping for have thus become a mirage, while only the mainstream assets favored by large investors and characterized by stability have shown steady gains. Overall, the next bull market is likely to continue this pattern, entering an era dominated by big capital and large cap assets. The chances of retail investors achieving tenfold or hundredfold gains with small cap tokens are becoming increasingly slim. At the same time, mainstream crypto assets have their own limitations. They lack support from the real economy. The risks remain relatively high, and returns are gradually declining. In this environment, for investors seeking stable returns, traditional stock markets may actually offer a better risk-to-reward profile. 3. Entering now feels more like taking the bag than getting on board. If you're only now planning to throw your mortgage, your parents' retirement savings, or your life savings into the cryptocurrency market, hoping to recreate the 2020 legend of turning $100,000 into $10 million, your chances of success are even lower than betting on a coin toss in Macau. The reasons are simple. Large investors have already been gradually distributing their positions to retail buyers in the $90,000 to $100,000 range. Early whales, addresses from before 2016, continue to sell on-chain. Historically the clearest signal of a market top. 99.9% of all coins will eventually go to zero, and even among the top 10 coins, more than half will eventually be replaced by new narratives. Against this backdrop, entering now is no longer a golden ticket like in the past. It's more like taking over the last bag from those who already made their profits. For those who have been trading for 3 years, it's time to let go of this get-rich dream. If you haven't made money in the past 3 years, it's better to step back and wait for the next bull market to rethink your strategy. 3. What truly smart people are doing right now. Cashing out the profits they made in 2024 to 2025 and rotating into cash flow assets. Permanently quitting leverage, futures, and 100x meme coins. These are casino games, not investing. Accepting the truth, cryptocurrency has evolved from a get-rich-quick shortcut into just another high-risk speculative asset, like the Nasdaq in 2000 or Bitcoin in 2018. The era of ordinary people capturing generational wealth is over. Conclusion: cryptocurrencies have now gone through 16 years of development and have become a very mature market. The cost of this maturity is that it will no longer offer newcomers the hundredfold or thousandfold wealth-making opportunities. If you missed 2017 and 2021, don't make the same mistake again. Acknowledge that this cycle has already peaked, and focus on protecting your remaining capital. This is far more important than going all in at the top in hopes of the next bull run. For 99.9% of people, the chance to completely turn their fortunes around in crypto has already passed. The myth of overnight riches in crypto is over. Looking ahead, the focus should shift to new growth opportunities. We should pay attention to projects that start from small technologies, but have the potential to gradually grow into major opportunities. Seeking the next wave of genuine value creation.